Hello everybody, welcome to the Flow Show. Thursday, we're nearly at Jackson's hole day, and whatever those clowns from the central banks are going to drop for us tomorrow does start today, or they all turn up today, so be prepared for some sideline doorstep interviews and things like that going on there, but that's for later. We haven't had the full schedule yet, but that will be coming. Morning Kay, how you doing, mate?
Good morning, Ryan. Good morning, listeners and viewers. I'm all right. We are the day after and the day before, in between what was and in between what's to come.
Okay.
It's visible in the markets as well today, right? It really looks like a transition day, although stuff is on the move. If you look at the euro dollar being in a 6.5 pip range since we started our day, the rest is gravitating around. I think we are waiting for what's going to happen in the hole.
Yeah, exactly. And let's hope we don't disappear down the hole. But anyway, right, quite a bit to get through today. So I'm going to kick it right off. PBOC still setting its fixes low, 7.1886 versus the analyst estimations of 7.2791. The Forex Flow live estimate last night was 1830, so we're only 56 pips off where they actually fixed it last night. So my proprietary model is working, touch wood. We'll keep that going for a bit longer just for shits and giggles. China is having another spat with Japan. They've announced suspension of all aquatic products from Japan due to this release of treated water from Fukushima. It's been threatened and now they're going ahead with it. So nothing traveling from Japan to China that has anything to do with water. Now it's getting a bit worse in China because apparently foreign investors have taken out 11 billion from China, 13 straight days of outflows, which is the longest streak since someone started counting back in 2016, or from 2016. So further exits from China going on there. And the China Commerce Ministry has been out on the upcoming visit of US's Raimondo, saying that China will state its position on economic and trade issues of concern. They look forward to in-depth discussions with the US side on resolving economic and trade issues. Now, this China stuff I've been thinking about quite a lot actually, and it pretty much seems like China's going into reverse. Their big plan was to open up to the rest of the world, but everything that's happening now seems to look like it's going the other way. You've got the US and other countries wanting to decouple from China. You've got China now finding its economy in the mire. Foreign investors are getting out. Even China's own citizens wants to get their money out of China. So it's all turning inward, and obviously their biggest play at the moment is to stoke the domestic economy, which is pretty much what they've got, all that they've got left if the rest of the world is trying to get away from China. So it's all from opening up, they're looking like they're closing down again, and that's the situation we need to trade at the moment. There's the global growth issue, and there's the geopolitical issue, and one's causing, as I say, looking like a close down while they're still trying to play opening up. It makes the situation, say, pretty tough to trade at the moment, because if China is going to shut down again or close up again, that's going to have a big impact on the global economy. What are you making of it, Kay? Because we've obviously got the market side of things, and then we've got the geopolitical side of things. They are seemingly growing divisions between the two, or divergence between the two.
Definitely, and we saw it on the during the BRICS summit, right? We had that release today earlier, and yeah, it does look like the geopolitical divisions are getting wider. also China is not missing an occasion to slap fingers wherever they can. If you look at the Japanese Fukushima water release, is going to take 30 years. There has been years of planning, years of testing, and it doesn't seem like it's going to be the disaster that China wants it to to make people believe. Well, nevertheless, it's never good to release nuclear rest water in oceans, but apparently it does seem relatively safe. But they're using every occasion to slap fingers on anyone who is not on their side, and then pushing very hard for Saudi Arabia, UAE, and then Iran. I don't know how that's going to work to access the BRICS. Yeah, I mean, it looks like more divisions than trying to make amends. On the other hand, they are still not closing all doors. It's a little like actually Saudi is doing themselves, right? Because we don't really know what Saudi's plans are until the next change of heart. Yeah, I mean, on the geopolitical front, it's not great. So I say I understand that that investors are very reluctant because the problem also with China is that you can invest in China, but what happens if they close things more instead of opening their bond markets also? Saying like, yeah, that's all nice and well. You can invest in China. You can invest in the companies. They're actually even trying to relax some rules, but then we also know that the day after they can tighten those rules again, and you can't get your money out. So it's understandable that investors are very cautious right now. Yeah, we'll have to see how it develops, and it could be like to bring it back to the trading side, a very long drag into what could be and very unclear what could be until the 1st of January 2024, and we hear from all the new members and the existing BRIC members, and then we will be 3 months further again, and we don't know what's going to happen by then in Ukraine and Russia. It's a very, very complicated picture right now, very complicated. But if you look at it then from an economical side, yeah, I mean, of course, if you attract a lot of money, let's say purely the money, you just look at the football, right? I mean, the Arab world, they can hire players at 200 million. Well, did China just hire $400 billion football players into the BRICS economy, right? That is somewhere the question as well. How is that money going to flow? And that's all a very, very complicated picture right now. At the same time, they are PBOC is fighting very hard against things. I mean, regardless whether it's the models right or wrong, and the fact is that they are fixing 10 big figures below where the market is. It's about 1.5%, and their 2% rule above below the fixing where the maximum can go. It's clearly a fight against the speculators right now. But if investors continue to sell, that's not speculators' money, right? That's investors' money. We have to make a difference between investors and speculators. So yeah, I'm not sure if it's so hard to call if they're digging themselves in a hole right now. Money will in the end talk, I guess. I'm looking at what's happening in this dollar China, and on the one hand, if it's only PBOC fighting against what's happening, I'm very glad to stay in my longs. On the other hand, once investors will have sold what they have to sell, what's left, then they can manipulate the thing back to 7 the big figure if they want, right?
Yeah.
So it's a very, very tough call. I'm going to just do what prices tell me to do. If we get back below 720, I'll be out. I'll still have made decent on whatever will be stopped out there then because I sold 731 2 3 on the way up, so I'm less in position right now. But it's going to be a very, very difficult call, and we may not actually know a lot more unless we get clear dollar moves in the other currencies, which is naturally going to drag the CNH around as well. Assuming that we have seen, in a way, and I'm not calling it by any means, but assuming that we may have seen somewhere a top in the yields and a top in the dollar, then I can imagine dollar CNH is going to be sensitive to it and go back down. If in turn the dollar keeps where it is, even where it is now, I don't see too many reasons economically, geopolitically, to go and start long China. So that's just a few words to say. It's really complicated right now what's going on over there.
Yeah, it's but we'll keep our eye on it.
I just want to reply to Brian's last line. Technically, it looks like a bull flag. Yes, but good luck with putting this kind of stuff onto. You got technicals, and I'd rather do trend lines or longer term trend lines or FIBs or so, but I'm not going to go into any flag or whatever considerations, because it's China, you know. It's very hard. It's like trying to call a bottom in the Euro Swiss or a top in the Swiss franc, because it's still driven by the SMB.
Yeah. So, as I said, we'll keep an eye on it. You know, we take a good long look at China, everything going on there. So, you know, we can roll with the punches day to day, week to week, to see which way things are leaning and which way the sentiment goes. And that's a good part of finding out whether which way to trade or not. Right, let's move on to Japan. And there's a story popped up in our newsroom today that SBI Global, who have $32 billion worth in assets, are looking at 2 new mutual funds for investing in super long dated JGBs and inflation linked notes to sell to retailers. This again is just a part of the slow rolling snowball that's going on in Japan, that now people feel comfortable to start changing up investment vehicles, looking at other things, the possibility that inflation is going to keep going higher and that yields are going to keep going higher. You're not going to get that many takers among the retail world when you're only paying next to zero on a bond, but if yields are starting to creep up, then it's going to become enticing for investors. A question I wanted to ask you, Kate, this isn't a case of selling to the suckers, but more a case of, you know, just switching around the assets, like we've seen a lot in other economies where rates have gone up. Could this become a big theme?
Yeah, is it a bit like the like money market funds for the longer term? Then they could actually see some interest from those perhaps the mutual funds and the how shall I say it, the big insurers and stuff, because they've already shown an interest, right? Remember a week or two ago we were saying that some of the local whales are already starting to buy 10 years and above, and we're only 15 or so BPs higher. Yeah, I think that's more like creating a fresh parking space for Japanese money, more than really. I mean, I don't see how foreign investors, if you can get 4 or 5% elsewhere, 4.5%. If you look at the 30-year US, you get 4.30, 4.40%, or a little bit less right now. But I don't know how you're going to invest in an ultra long Japanese bond where, let me just see where they are now, where you get 1%, a little over 1.5%, 1.6, something like that.
Yes, that was my other question. Then is is this something they're going to wait until yields are high? Because no one's going to buy a bond now at those rates if potentially going to be 2% or double 6 months, 9 months, 12 months down the line. If you're looking to buy a bond for the yield, you're going to wait for yields to go up first, aren't you? Or would they be looking at shorting bonds in the funds?
Then the local people, they make a difference between. But, there's been a lot of talk about the hedging costs and why Japan has been selling, for instance, US and European bonds and buying back Japanese bonds. Is because the hedging costs were not were too high to stay outside, and then you prefer to get your money back, because if you say that like for instance that the okay, I don't know the exact level right now, but if you invest in a 30-year Japanese bond, and where the US at 165, where the US bond pays 4.25, but your hedging costs are via the swaps and stuff are higher than those, and your dollar yen as well are too high. You actually inflation adjusted and stuff like that, you're actually going to be better off at home. That's how they judge things. It's not like us, where we see like if you trade FX, you go like, oh, Japanese 10s is 0.64 and US 10s are 4.20. I mean, it's a no-brainer because you get money for being long. It's like a carry trade, but they don't think like that. They think for their long-term investment, and then if they look at the hedging costs, they are too steep right now to really go outside with a lot. So that's a bit how they look at it. It's a bit of it's another one of those complicated ones, but yeah, I think they've been starved for so long for return in Japan that now whatever return they can get, they are going to be happy with it. And I tell you, if so, the top end of the Japanese JGB yields is 1% right now. I bet you if we go to 1%, they are going to bite fingers off to buy those bonds.
Yeah, I suppose the other side of the coin is as well. You're not going to get that return just normal savings in a bank, so that can cause people to get into those bonds as well. Just normal cash parked up. But anyway, another one to look at further down the line. Speaking of the yen, the head of Japan's stock exchange is saying the yen is too weak, and the benefits of a weak yen is apparently waning, and that negative effects are starting to show, primarily pushing up import prices. That's evident in the news out yesterday that gasoline prices hit the highest in 15 years and has been gaining straight for 14 weeks. That's why Kishida is going to be looking at extending subsidies, as we reported earlier this week. They're supposed to expire at the end of September, but now there's moves afoot to get those extended. That's also going to eat into Ueda's and the Bank of Japan's thoughts about import price inflation waning in the latter part of the fiscal year. That looks like it may not be happening, and thus we're going to see whether that starts filtering through more to domestic prices. On that front, keep an eye out tonight. We know we've got Jackson's Hole coming up tomorrow in earnest, but tonight, early hours of tomorrow morning, we have Tokyo CPI, which is the first of the August inflation numbers. So that could be a bit of a mover for dollar yen ahead of whatever happens at Jackson's Hole. So pencil that to make sure you check out what happens there. Obviously, we'll bring it to you on the Flow Show tomorrow. Over to the good old ECB. JP Morgan now expects the ECB to pause in September, and they've knocked their September hike until October, apparently. Don't ask me why. If they have reason to hike, they're going to hike, be it September or October. But that's bank forecast for you. Now over to the UK, and just a few headlines that have been floating around this morning about the UK construction sector. The FT, in its usual glass half empty and thrown on the floor, smashed into a million pieces, has reported that UK construction companies have gone bust at the fastest rate in a decade. Some 4,000 odd firms filed for insolvency last year, which is up 16.5% than the year before. Rising input costs, material costs, planning delays, and skill shortages have all said to be the contributing factors to that. Now, as I said, the FT make it sound like a big, huge headline. I did have a look, and they don't say it in the article, so I Google instead about how many UK construction companies there are, because 4,000 is a big number if there's only 5,000 registered companies. I can't find an actual number. It's anywhere between 50,000 and 914,000, depending on what year you look at and what number. The latest numbers from the US had it around 360,000 firms. So that's just over a 1% loss of insolvencies. So in that term, it's not a huge amount. But as I say, it's not the only construction headline to cross the wires. Persimmon is a big, one of the biggest, if not the biggest, construction company. And they are set to come out of the FTSE 100 after 10 years of being in there due to their poor performance of the share price, due to obviously poor performance in the construction housing sector. We know we've got mortgage problems with higher rates. We know we've got skill shortages. We know we've got a problem with house building. It's not looking too hot in the construction sector, house building sector overall here in the UK. That's something that might feature in headlines and on the BOE's platter to come. Right, coming over to the US and sticking with the housing theme, MBA mortgage applications fell again, down 4.2%. That's now on a pretty hot streak of lower numbers. The mortgage rate, the effective mortgage rate, went up again, 7.31% versus 7.16% previously. Let me get that up for you, just so you can see what I'm talking about. There, the MBA numbers there. So not looking too good in that index. And this one can be a bit of a front runner because it's a weekly data point. It can be a bit of a front runner for what to expect in the housing market. And there are some signs, no big flags yet, but there are some signs of a bit of creakiness creeping in. We also got the new home sales, which had a positive. It was up 714,000 versus 705k expected. On the price front on those numbers, prices were down 8.7% year on year to 436.7 thousand. But that price was up from June's 416.7 thousand, so up 20k since last month, but down 8.7% on prices last year. Fed Bullard, or ex-Fed Bullard, who's now left the St. Louis Fed, said that recession fears have been blown out of the water and stronger growth will require higher rates. One of the biggest hawks at the Fed, but I make him right about this. It's something I've said over the last few months now and again, that one of the ways that the Fed will be forced to hike again is if this soft landing business means the economy heats up to a level that brings inflation along with it. So strong growth, strong jobs. If the economy isn't suffering too much, that's going to bring its own pressures, and rates are usually used in normal times. Don't ask me the last time we had normal times, but in normal times, rates are used to control economies where they're overheating or cooling. So if this data persists in terms of things not going south, then he could well be right, and that will be the reason why the Fed hike again. But on the data front, it's looking a bit of a mixed picture. We got the PMIs out yesterday, the US PMIs. Manufacturing slipped further into contraction. Where was it? Oh, I've lost it. There we go. So manufacturing down to 47, so lost a couple of pips over last month. Services gave up some as well. Was expected to come in unchanged, 52.3, fell to 51. So just hovering above the contraction expansion line at 50. We'll have to see what the ISM show us in a week or so's time, because that can be vastly different from this number. But I think that services number was the important one. The fact that it held up meant we didn't get, or there was no need to hit the dollar too hard on that, much like we saw with the Eurozone numbers in Germany prior to that. However, we did see the dollar get hit anyway. Just a quick one as well. Eurozone consumer confidence coming in -16, worse than expected and prior. No shock there. You'll do well to see that number turning positive. So we had a bit of a move yesterday. Let's go on to dollar yen, just for a quick look. We saw yields come off yesterday. Now, as I say, the data wasn't overly bad. It was a bit soft, but it was in the could have been worse camp. Dollar yen decided it was going to crack through 145, shake the tree out a bit, but as you can see, we're back up above now. So the dollar's demise hasn't even lasted 24 hours or anything like that. There's been quite a bit of tree shaking going on all round. As you can see, there's the yield picture yesterday. I did have a bit of a thought that if we did crack this 720, it might spell a bit more problems for the dollar. But there's not been much of a bounce yet compared to what's happened in dollar yen. So there's a bit of a divergence there between yields and dollar yen at the moment. That needs to keep an eye on. If we continue to see yields coming lower in the US, then maybe that's going to put the brakes on the rally in dollar yen. If that happens, you might want to think about shorts if we get up to some of the upside levels again towards 146s. Dollar CAD as well, similar situation. Decided to tag 136, then got a real big slap round the chops, knocking us all the way down. Near enough to have a test close to that 135 area again. Did its job, it's held up. Now we've seen a bit of a bounce, puts us pretty much in the middle of yesterday's range. Got this 135.50 to see if that's going to start having an effect again. It's been, as you can see, a bit of an on-off level. If we get above here, if we wash it out a bit, I'll be watching these highs back around the 70s, 75s. If we get a hold up there, that will suggest this top is a bit of a blowout, maybe like what we saw down here. And then we have to see what we want to do there. Are we going to keep the pressure on the upside, or are we going to have a further move south? While this 135 level holds, though, call it down 134.90. It keeps the rally in play, so there's every chance that we can still go higher. We know this has been a big, strong move over the last few weeks. What can happen is people get a little bit more nervous up here because you get all the latecomers who are buying around here. It means that if we do break here, it might be a bit of a cascade, and we see a steeper loss. So the longer we remain above here, the more I'll be inclined to look at maybe a break short if we look like we're going to break it. I'm still long. I took a bit more off up into 136. I'm happy to stay long, but I'm going to watch this price action because I might decide to tighten my stops right up on that basis. Going to need to take out that 136 to continue this rally. Otherwise, we may be in for a bit of sideways action, and then we're playing the range game again. Euro sterling, another one. It had the decent bounce off of the 85 handle, got up, couldn't quite get up to 85.70. Then we've had a bit of a pullback. It's now advancing again. Wasn't looking too hot when we were coming back down to here, 85.35s, but it's held there. So bit of indecision now. what we do from here. Are we going to continue moving up, or are we just going to float around in this tightish range? I still don't think 85 is out the woods just yet, unless we get back above 85.70 and the 86 handle. I think this is still in the frame to see some action. If we do get a swift move back down there, I'm going to be very worried about that move. I won't potentially be looking to add back in on another move down there, but I've got some sell stops in play, and I'll keep those going for the moment. S&P, I wanted to have a quick look at as well. I finally got knocked out my shorts from up in the 45. Yes, mate.
Look at the CBI distributive trades numbers in the UK.
Oof.
It's horrible. Minus 44 versus minus 25 expected.
That's that one there.
That's a bit of a... Yeah, it was minus 25 expected on Reuters. I don't know why investing does their own stuff, but it's looking pretty bad. Although it's not like the number that everybody watches like a hawk. It's just adding to a picture again, right?
Yeah, when you get it's not one that's usually a big market move unless you get a big variation like that. These guys it's a very pessimistic survey. CBI, they're very pessimistic UK in general, but yeah, that'll be why Euro Sterling's knocked back up then, and cable's probably got a knock on the head as well. There's a quick look.
Just a few pips really, but it was already slipping before.
There we go. Yeah, so a little knock on the head there. Yeah, so I was talking about the S&P quickly. I got knocked out my short trade. All good things come to an end. I'm a bit neutral now. We got back above the zone. It did start to hold it, but now we're just bleeding back through it. So this area down here, 144, 40s, 50s, is going to be the important point here. If we hold that, it keeps this bounce in play. If we break that, that suggests that we're potentially going to keep the trend going. We haven't made a new high above this area here. So that's the next step that it's got to take if we're going to continue this bounce. That will be something that starts to break the trend. It's a 61.8 up there as well, which is always a good measure, last line in the sand for whether a trend is reversing. As you can see, though, we hit the 50 fib, and that's where we tagged it by a few pips, but we're back below now. So we're bang in the middle of this range here, and I'm not sure which way it goes from here. So I'm not too keen on trading it in the middle here. If we get a move, we know where the range is now, down into this 43.30s, up into the high 45s, 46s. That's your wider range to look at. And there's probably enough for you stockies to play in between, but I like to play the bigger ranges on this one when I'm playing stocks and stuff. Kay, do you want to take it over, mate, and have a wander around?
Yeah, sure. Yep. Okay. So, if we look at what's going on in that in after those numbers, we had this just going quickly onto the euro dollar, and I'm going to go on a tighter time frame. So we had this knock lower yesterday on the PMIs. Then we had the US PMIs, but we are stopping short of what my first level to monitor is around 108.80, which is it is the 61.8 of that run up that we have, and it's also, if you look at the years range, the 50% is around 108.80, and I think that's one interesting enough to watch tomorrow, regardless of the rest of trend lines and stuff. Regardless of all of that, that's an interesting one to watch tomorrow after Powell and Lagarde, whether we are below or above this one to close the week. That's going to be my at least first indication of what's to happen with the euro. Yeah, the wedge was a little bit, we could have put it here, but then if you really have the lower end of the moves, taken into account, it held right there, right on there. So 108, the figure, is going to be your break level for moves lower or not if we break outside of the wedge. The opinions are really divided right now because people are starting to look at those yields, which are coming back off from the 430s, thinking that due to the data we are seeing, which are slowing down yesterday on the PMIs, that we are going to have a dollar that is capped. But if you look at the European data are weak as well. The sterling data weren't great either on the short-term stuff. But if you look at the differentials, which I'm always keeping an eye on, they do not support a bigger bounce in the euro dollar yet. Can even go on to the shorter time frame. We are literally 4 BPs or so of the lows, and even during yesterday's data that we saw, we had a bit of a blip higher again, but then we started to come off again. The differentials are not yet supporting a bigger euro dollar bounce. Now, this being said, perhaps into the whole, this is not something that we should be banking our trade on. But if you look at the sterling differentials, they are also hanging around lows that we saw of the latest moves. And be a bit careful because they are just, if you look at, this, I don't know what the exact reason is, but I'm just following the market on this one. I'm looking at the EU 2s and the sterling 5s because this is what most people look at. Don't ask me why, but this is what most people look at. Okay, if anyone would ask the question one day, just say, I don't know. Kate told me that that is what I have to look at. So we are hanging around lows of late. So if you look at the differentials pure, that is not supporting bigger rebounds in the cable either. All right. So that for the differentials where we are at right now. Again, I'm not saying that going into Jackson Hole, positioning and what else, we can't move up to this 108.80 or so. But if you look at the differentials, and there's a lot of models trading on the back of those differentials, I wouldn't say there's a move to support, for instance, a move back above low 109s or 109.5. For tomorrow, I think we have to look. Okay, this could be your barometer for the end of the day, 108.80, and then we have to look at outside. And I think outside, it's either going to be 109.10.15 again, or it's going to be somewhere closer to 109.5 probably. If we start to get above 109.5, then something has been said at the Jackson Hole meeting. And again, I think today we're rather in a transition day than really a day to take major directions. So I'd be surprised if today we are going to break 108.30, let alone 108 the figure. But those are the levels that we are going to have to watch going forward, okay? If you want to be intraday trading, if you want to trade the noise, I'm not very inclined to do it. But if you really want to trade the noise, these are, I think, the low 109s and the low 108s is really where it should hang in between. On the cable, again, we yesterday we had this bounce, I think, on positioning, dollar positioning, but then we stopped around 127.30, which is a fib I have here, 127.27. Sorry, is the 50%. It's not a fib, it's just a 50%. And it stopped right there. So that's your marker for the short term. And on the downside, I think anywhere between 126.5 and 120, those lows again, where we have this triple bottom now, are going probably to hold over the day if ever we get some more weakness in the sterling there. So if ever by tomorrow evening we start to break this and going into next week, then it spells much more trouble for the cable. But in the meantime, I'd say trade the ranges. One or a couple that we have to talk about are those metals, right? Silver really has put in a strong performance. Okay, we've stopped in this bit of traffic zone coming up, I think all the way up to 24.90. We have to be a little bit careful that this rally doesn't run out of steam and we see a deeper correction. But in the meantime, this is still looking pretty strong. So if you are in position, I'd say be a bit careful here, but it's looking pretty good. I've just taken a tiny bit of, I added in those 23.20s quite a while ago, actually. I think, yeah, it must have been beginning of August, and took a little bit off, but I'm going to keep the rest, probably fold into my long-term longs, and if I see levels again into the lower or mid 22s, going to jump back into it. Gold as well rallied back above 19. I think the first really resistance zone is going to be 1925, 1930. Keep an eye on that one. The other one is going to be 1940, and then we're talking about 1950, 1960 again, okay? To be healthy for gold, it should really hold 1900, maxed at 1885 again. Again, I think kind of a transition day today. I'm not sure whether we are going to push further much more, but we will have to look at the what the yields are doing for that one. And if you allow me, Ryan, I actually noticed this trend line on the S&P. And that comes in around 44.80. So if that together with your zone up to 45s, I still think we are in a relatively important zone here, because if you start to push through those things, also we have some moving averages around there, which are around 4,500. It's a pretty important zone. Now, that being said, personally, I think there's a lot of NVIDIA in there, and I'm not sure whether really there's fundamental reason to really push through, unless we see a further coming off in the US yields, especially, or in the global yields, as a matter of fact, because European and UK yields, for instance, are also coming lower. By the way, the JGBs have also shied away from closer to that 70 zone. I don't know really why, but they just do. On the yen, then quickly, so 145 is starting to water out. Just an interesting one here. I know we should probably be taking this low for the whole move, but this is the Bank of Japan low. And if you look at the 78.6, the 23.6 of the Bank of Japan, post Bank of Japan move, that's where we stopped yesterday, around 144.55. Okay, so I reckon this level is already important enough. If you want to have a little wider look, it's around 35, 37. But I reckon the Bank of Japan here is worth having a look at it. And we know where the top side lies, right? This is really clearly your level to watch here. If we start to break above mid 146s, then I think we're on our way to 150 probably. Now, few questions. I don't see too many. Why NVIDIA is the voice of mouth everywhere in the market? It's just because it's the AI is the subject of the moment, Ali, and it drags everything around. Look at what the Nasdaq did. Look at what the S&P did. Look at what all bourses did. And likely also the fact that the yields were coming lower. It's a combination of everything. But if you look at where we are now compared to where we were before the close, there's definitely an NVIDIA impact in the markets, right? I think that's pretty undeniable right now. Whether it lasts, that's another thing. We'll have to watch around that. Okay, yeah, indeed, Gavin. I even saw someone talk about $675 also. Ryan, back over to you, mate. I don't. Yeah, I'm not. I'm just playing ping pong in the dollar CAD range. You know, I've been showing this congestion range. Yesterday we broke above, back inside, but there's still relatively enough support around 135 to play it, and that's what I'm doing. I've already took some off, but I'm just playing a bit of ping pong inside this range. If it breaks out to the downside, I'll be gone. By now, it's already a very, very cheap trade if it would go back below there. Right. Is there anything else, guys, that you want to look at before we call it a day? I think that's all right. No.
Cool. Well, people can pop it up in the comments there if you want us to talk about something.
Yeah. 64.90 here on the Aussie. First retracement of the move lower. That gap for now. Interesting one to watch. Okay, that is one thing. And Ryan already talked about whether here or in the chat room about the Kiwi, which is also struggling a bit. And I think we'll keep it to that for now. Back over to you, Ryan.
Yeah, thanks, mate. I'll just grab it back, if only just to show something. 1 second. So we don't have a blank screen. Yeah, good luck with that, Brand. Ruby Rand. Yeah, I'll let you try that one. Right, so just keep an eye on the data today. We've got a couple of bits. Durable goods, which is actually expecting to turn around the strong number we got last month. We got a 4.7 last month. We're looking to wash out that quite significantly. So that's quite a big number for durable goods. So keep an eye on that one, because anything different is going to have a say in the market. If it's not as bad as expected, that will be positive for the dollar, and we might see yield back on their horse again. Keep an eye on the cap goods orders, non-defense ex-air. That's seen as a bit of a capex category there. That could be a bit of a change up to whatever comes from the main number there, and keep an eye on core durable goods as well. Jobless claims as well, still sticking around the 230s, 240s. There again, look for any big variation from that one. Right, if you guys and girls have got nothing else to look at, we shall leave it there. Enjoy your day. Watch out for any sideline headlines from Jackson's Hole later, and watch out for that schedule. We know a few of them, but we get the full list later today when the bods at the KC Fed wake up. Thank you, Kay, for all your input as usual. Right. We will see you all for Friday's beer session tomorrow. Have a good one.